Patnaik of Religare has joined me now to talk about markets post the budget. Tirthankar, morning. It's been very sluggish last couple of days after the budget. The market seems quite unimpressed, and even the bond yields are refusing to come down. Do you think markets are factoring in some slippage in the deficit and not that 5.1% number which the government has indicated?
Clearly, the 5.1 number that the government has come up with does leave a pretty much high room for upside. We believe that the overall number finally could come in at about 5.8%, slightly lower than what we saw this time at 5.9%. But it will clearly slip up. Actually, not anywhere near about 5.1 that we are saying. Where is this slippage going to come from? Then I think subsidy numbers that the government has put in. Clearly leave room for upside there. 43,000 crores is not what might pan out. It might be closer to about 75 to even 90,000 crores depending on how much crude remains, at what level crude remains, and basically what happens to the currency. And also the government's revenue estimates from telecom are on the quite on the high side. We don't believe they will generate 58,000 crores. We believe the number would be closer to about 38,000 crores. So putting this in line and also looking at a little bit of their revenue assumptions on corporate tax, customs duties, we believe that this number is clearly going to be higher, and that's essentially what's weighing in on the markets as it looks at considerably higher borrowings this year.
Where do you think the final borrowing number will be, Tirthankar? Because the bond yields are refusing to come down, and I think the street is working with much higher estimates than what the government put out. Do you think it might be a tight situation like it was last year from a bond yield and from a liquidity perspective again?
See, last year the government, I think initially started at a little north of 300,000 crores. They ended up at more than 500,000 crores. We have just seen the third supplementary grant essentially tabled in the parliament. So clearly last year was a stretch situation in terms of borrowing. The government was borrowing not only on dated securities but also on the ways and means advances, where it was essentially paying 10.5% rate. This year, on top of that borrowing, the government is likely to borrow nearly 30,000-40,000 crores extra. So while the net borrowing number at 470,000 crores doesn't look very high, we also have about 90,000 odd crores of redemptions coming in, which will push the overall number at 570. And this is when the government is saying that it will have a fiscal deficit number of 5.1. So clearly there is upside for this borrowing target, and that has essentially also panned out on yields. I think yields, near term might remain where they are around 8.4-ish levels, as and when the RBI comes out with the borrowing calendar, and which will happen at around the about April 15th or 17th when the policy comes in. That's when the market will take a fresh look at what happens with pressure in terms of does it happen in is it front loaded towards the first half of the year, or will it essentially happen towards the second half of the year.
Should the market be hoping for oil price increases in the kind of political backdrop that we are hearing right now, or do you think barring petrol nothing meaningful will be achieved?
See, the numbers that the government has put in do subsume that there will be a hike in diesel prices, that's for sure. Having said that, given the Congress's performance over the last couple of weeks, firstly at the hustings and secondly with what happened with the railway budget, the market is sort of right in expecting that petrol hikes is the max that they can hope for. Our own calculations are that we will see a 2 rupee hike in diesel coming this fiscal year at least, and about 4 to 6 rupees on petrol.
How do you play the banks then, Tirthankar? Because both on concerns of what is happening with liquidity, the bond deals, etc., and also of late with the way some of the asset quality pointers are coming up, first with Kingfisher, now increasingly with Hindustan Construction. Public sector banks particularly seem to be correcting quite a bit. Do you think there's more of a correction waiting there?
See, liquidity is likely to remain tight now. I mean, we had highlighted even after the 75 basis point cut in CRR that liquidity positions are unlikely to ease. So the central bank, in our opinion, maybe will not go through another CRR cut in the near term, but open market operations have to happen this year because liquidity, one has to look for about 7.5 lakh crores of overall deposits coming in, and we are already looking at a 570,000 crores of government borrowing program this year. So clearly liquidity is likely to remain tight. Having said that, on rates, the market was expecting about 125 odd basis points cut on the repo during this fiscal. After the budget numbers, clearly there's been a lot of equalization coming there. Our numbers have been around 100 basis points. We shall maintain that. I think with the current scene, we might be looking at 100 basis points on the max that we can see on the repo this year. So I think until the borrowing calendar really clears up, there's not too much to play here. We do have a positive stance on rate sensitives for this year because we believe that the RBI's focus will have to go for growth at some point, and this is the time to focus on growth. Two to 3 quarters hence from now, inflation is sure to pick up, and that's when it will be very, very difficult cutting rates. At this point, one has to take stock of the situation that after an 8.5% growth last year, we're looking at just 6.5% in FY12, and government numbers are quite optimistic on FY13, but we believe that it will be similar, just be around 7%. And quite a lot of the street is actually below that. So if the RBI has to cut rates, it would have to be towards the first half of the year, and which is why we believe that we will start with the repo cut on the in April.
What about the market then, Tirthankar? Do you think for the near term, for the next few weeks, maybe even in the next couple of months, we are consigned to a trading range then?
I think after the budget numbers, like I said, clearly there's been a lot of disappointment in terms of expectations of a rate cut, and that too on, inflation numbers marginally picked up from 6.5 to about 6.95. I think going by what we are seeing, any kind of, any rate cut in April should be a marginal positive for the sector. And going forward, we believe that, the RBI will cut in the first half. So there could be a positive surprise. Barring that, with oil remaining where it is, we might see just limited downside at this point. I'll put it that way. We might just see limited downside from here.
Tirthankar, what's your view? You were just talking about limited downside. Do you agree that generally, even if we drift down from here, somewhere between this 5,000 to 5,200 zone, the market will find support again and hold on to that?
See, one has to see it in terms of what news has been already known to the markets. That we are in a slow growth mode, that we have had, we were expecting a big number in the fisc, that we are seeing inflation coming down. All these things are known in the markets. The market is essentially looking for clarity as to what happens in terms of the exact borrowing calendar of the RBI. How are they going to pan out on yields? At this point, like we had said after the budget also, nothing hope and nothing hope, nothing gained. It was essentially meeting zero expectations. So to that extent, I think downside in the market is capped to my mind, and that would essentially now depend on what happens with global cues. Numbers from FIs have been touching $9 billion at this point, and this has been through all these negatives. Even after the Congress's negative performance in the at the elections, we still have had money coming in. So I think for the foreign investor at this point, India's performance going forward, India's growth going forward, what happens with inflation trajectory is more important than near-term concerns on what have you, elections, budget, and so forth.